Alright, what's up everyone? Welcome back to Compound Interesting. This is Emil, and in today's video we're having a look at LMND stock, which is disrupting the insurance industry and recently IPO'd at $29 and rose 134% in one day, and now it's trading around $77. So welcome back to Shit Shirt Sundays, where I bring you a completely normal video, except I'm wearing a shit shirt because it's Sunday. So there's no common theme across these videos except the shit shirt. And also, this video happens to be a part of the Worth the Hype series because this is a really hyped stock right now because of the extreme growth in its stock price. 134% is crazy as an IPO. So obviously a really hyped stock. Alright, so when researching this company, I didn't find any really deep dive analysis into LMND stock on YouTube. So today I want to give that to you and hopefully give you a really clear picture on LMND stock and exactly everything you need to know about it. So we'll be running through LMND's full opportunity, their total addressable market, the amazing business model that LMND are doing. We're going to quickly look at its previous performance and my estimates of its future performance. We're going to look at its valuation, whether it's cheap, fair, or expensive. We'll look at the risks, and finally I'll give you my opinion and exactly what I'm doing in regards to LMND stock. So with all that said, let's get cracking. Alright, so before we get going, I just ask that you smash the thumbs up button. Really appreciate it. I really hope you enjoyed this video, and if you haven't already, make sure you're subscribed, click that big red button and the notification bell because I'm a small channel. So if you're enjoying my videos, it won't appear in your recommended feed unless you've commented, liked, subscribed, and hopefully hit the notification bell so you actually get the notifications, so then you won't miss any of my videos. So first, let's run through an overview of LMND. Alright, so LMND's mission statement kind of sums them up pretty well. It's to harness technology and social impact to be the world's most loved insurance company. So basically, LMND are extremely consumer centric and they're committed to bringing down prices for the consumers and leveraging artificial intelligence to do this and bringing the most accurate pricing models, or finding the most accurate pricing models for the customers. It's so easy to get a quote and to make a claim using LMND because they're using artificial intelligence bots. So if I want to get a quote for insurance, I'm talking to Maya, the AI Maya, and I'll get a quote within seconds by just giving some quick information. So they're leveraging AI, and I've tried it. I tried it because I always like to try the products before I invest or research them. And yeah, it literally takes seconds and it's really easy and simple. And it's apparently it's the same if you want to make a claim. 1/3 of their claims are done by artificial intelligence, AI Jim, and they'll give you your claim, they'll give you your money within seconds after you submit the claim. So usually with legacy companies, insurance companies, you'd be waiting weeks for both a quote. You probably wait a week or a few days for a quote, but you'd be waiting up to months for a claim. So the AI can tell straight away whether it's a fraudulent claim or it's legitimate, and no human intervention is needed, which is crazy. And obviously that's way cheaper. Alright, so let's have a look at their total addressable market, which I always find to be extremely important when you're assessing a company. I always want to have a look at what their total addressable market is. So I'll play a little snippet from one of their presentation videos, and I'll link that video in the description if you want to watch the whole thing. It gives you a pretty good insight into the company. But here's a little clip.
The first one was just how vast the insurance sector is. In America, you're talking about something like 11% of GDP, and it's about $5 trillion worldwide. Some of the largest insurance companies in the world do over $100 billion a year, but none of them has above 4% market share. The idea that you can be a Fortune 100 company and have only 4% market share, that just blew our mind. The second thing that we found was that it's largely unchanged. It's really dominated today by the same companies that dominated 100 years ago, and sometimes 200 years ago, and sometimes 300 years ago. In the United States, 12 of the Fortune 100 companies are insurance companies, and their average age is about 125.
So clearly you can see that the insurance industry is absolutely ripe for disruption, and there's an enormous total addressable market. This could allow LMND to grow for decades by continuing to eat into this enormous market, like 11% of GDP. That is insane. Now let's have an in-depth look at their business model, which is truly completely innovative and remarkable. So as we know, AI has taken over the world, and I mentioned how easy it is for customers to get quotes or make claims using Lemonade service. But the AI is getting better and better as time goes on, as they get more and more data, and legacy systems are using far less data points than Lemonade are. So Lemonade's pricing, the accuracy of their pricing models will get exponentially and will continue to get exponentially better with time. Their AI even picks up on whether you're on social media at the same time as getting a quote, and which would obviously potentially negatively impact the quote that you get. So they're using like crazy amounts of data to get you a quote. Alright, so now I want to talk about the most bullish factor about Lemonade in my opinion, and that is the fact that of their target audience, which is going after the younger generation. So insurance is a sticky business, meaning that it's a bit of a pain to switch your insurance providers. So you're unlikely to switch insurance providers unless you have a really bad experience or you're offered a much better deal with another insurer. So as long as Lemonade can continue having great customer service and decent prices and pay out legitimate claims, they can keep their customers. And why is this so bullish? This is so smart because the young people who start out on Lemonade, because it's like so much simpler and much easier and much less of a hassle to get a quote and everything than legacy insurers, those young people, they might only paying like $10 a month now for home insurance because they're just renting a small apartment. But as they get older, they're going to be moving into a house, they're going to be having kids, they're going to be having pets, they're going to be having cars, etc, etc, etc. So the lifetime value of these customers is enormous, and to get them while they're young and provide great customer service means that they'll be able to reap a long amount of rewards in the long term. So at the moment, 70% of Lemonade's customers are under the age of 35, and 90% of Lemonade's customers are first-time insurers, meaning that they're not switching from another provider to Lemonade. This is the first time they're getting insurance for their house or whatever. From this chart, at the moment, we can see that 10% of homeowners on Lemonade's platform were previously renters on Lemonade's platform. And you can see the growth in that percentage over time. And this growth is probably going to continue. So this graph is showing us that previous renters on Lemonade's platform are, when they're moving into a new house or whatever, are continuing to use Lemonade's platform. And a larger and larger proportion of Lemonade's home insurance customers were previously renters on the Lemonade platform. So over your lifetime, or an average person's lifetime of having house insurance or insurance in general, you'll probably spend an order of magnitude more by the time you're like 65 or whatever on insurance, so like 10 times more. So you might start off with $10 a month on insurance, but by the time you're retired, you'll be spending $1,000 a month or $100 a month at least on insurance. So obviously younger customers make way less money in the short term, but the long-term value of the younger customers is much bigger. Whereas legacy companies, legacy insurers, instead of going after the younger people, they prefer to try and get older people to switch to their platform by offering lower insurance premiums. So their ads will always say like, oh, Jane saved $100 on her car insurance, blah, blah, blah. Like, we've all seen those ads and they're not that enticing, let's be honest. And we can see this already. Like, Lemonade's been around for 3 years, and those customers who joined 3 years ago are already spending 56% more on insurance. So if you're enjoying this video, just quickly ask that you like if you haven't already. Would help me grow and reach more people. Alright, so now let's talk about their pricing model. So we know they're going after the younger generation, but what else is different in Lemonade? So their pricing model, they take a 25% flat fee of your premium. So if I'm paying $100 a month in insurance, Lemonade takes $25 as a flat fee, and that's their profit, and the remaining 75% is held in reserves for your claims. And if there's anything unclaimed out of that $75, that will be donated to the charity of your choice. So this means there's no conflict of interest with Lemonade and you. So Lemonade take their flat fee of 25% and they don't care. Like legacy companies, they'll try and pay back as little as possible in claims because those claims are going to their bottom line. So they'll make it really difficult for you to make a claim and to get your claim. Whereas with Lemonade, any remainder of that $75 is not theirs anyway, as it will be going to charity and it won't be going to their bottom line. Similarly, if I'm making a claim, I'm much less likely to make a fraudulent claim, because I know if I make a fraudulent claim, I'm taking money of that $75. Instead of the insurance company losing out, it's the charity of my choice that would be losing out. So it's kind of a win-win for both parties. Alright, so I was a little bit worried when I was digging through the company that they're capital light, meaning like most insurance companies, like in case there's a rainy day or a massive thunderstorm or massive weather disaster, like insurance companies have to keep enormous amounts of capital on hand. However, Lemonade doesn't keep massive amounts of capital on hand. So I was a bit worried about this, like what happens if something goes wrong? So I digged in, and I'm not going to go too deep into the technicals, but they use reinsurance. So basically they sell the insurance that they get from you, they sell it on to a third party who has to keep all the capital. So Lemonade sells on 75% of their premiums, so all the money that people pay to them, they sell that on to a reinsurer, and that reinsurer guarantees those loans, and Lemonade keep the other 25%, that they'll look after that if anything goes wrong of these 25% claims. That might sound a little bit confusing, and I'm not going to go too in depth on it, but from my understanding it all clears out. It seems it's okay, it's not something to be worried about from my research, but you can dig into it a bit further in the company prospectus, which I'll also link in the description if you want to understand this model a little bit better. But basically what this reinsurance model allows for is consistent gross margins or margins. So it doesn't really matter if there's a natural disaster. Lemonade will only have to pay out 25% of the claims. So there's less risk because the reinsurers are taking on the majority of the risk for Lemonade's business model. And it means that Lemonade don't have to have loads and loads of capital on hand, which would be hard for them to get right now, and which would be better served in growing the business and in advertising, general administrative expenses, etc, etc. Alright, so now let's have a look at the previous performance, and then I'll give you my estimates of their future performance and whether the current valuation is fair in relation to this potential future performance and how much they have to grow to reach the current valuation, which is obviously quite high. So Lemonade have 7x their customers in 2 years. So in 2018 they had 380,000 customers, and now 2019 720,000. So that's only over 1 year, those numbers there. But yeah, since 2017 they've 7x their customers. So hopefully they can keep growing at those kind of extreme growth rates. Their loss ratio dropped by 296%, and now their loss ratio is 70%. And this loss ratio should continue to drop. And the loss ratio is basically, so how much are they paying out in claims in comparison to how much they're taking in money. So previously they were paying out way more in claims than they were getting in as money. So they were losing enormous amounts of money. But now their loss ratio is 70%, so less than 100%. So they're taking in more money than they're paying out in claims, which is obviously necessary for an insurance company. But they also have other expenses like advertising, etc. So Lemonade as a whole are still losing money. They're the top rated insurer by a few different sources in the United States, which is obviously great because their customer service is excellent and so easy to use, blah blah blah, and their claims are super easy to get as well. There's no hassle, you're not waiting for weeks to get a claim, and they really look after you, so that's great. The revenue grew 140%. Their quarterly revenue growth was 140% year over year. Okay, so now let's have a look at my estimates and of the revenue growth. All right, so their price to sales ratio is 40. So if you've watched any of my videos before, you know that price to sales ratio is the metric that I like to look at the most, particularly with extreme growth or any sort of growth company, because earnings are sometimes non-existent or not indicative of the future potential of a company. But the price to sales ratio is a better metric paired with the growth rate and the future growth potential of a company. So now let's have a look at some estimates for that. All right, so these are extremely rough estimates, so there's no real logic behind these estimates except like speculation. So basically what I was trying to do is determine how long it would take Lemonade to grow at kind of these kind of extreme growth rates, how long it would take them to get a fair price to sales ratio, because a price to sales ratio of 40 is obviously extremely expensive, but we want a price to sales ratio maybe of 2, which is fair. But for a growing company, maybe like 4 or 5 would be a fair price to sales ratio. So you can see the graph, the 2017, they earned 2 million. So we can see the revenue in billions there. So revenue in billions is this is 0.02 in 2017, 0.002. So that's $2 million. Then in 2018, they earned $20 million. 2019, they earned $67 million. And in 2017, they 11x the revenue from 2 million to 22 million. And then from 2018 to 2019, they 3x their revenue. And that's actually what happened. So that's why that's in green. And now looking at the yellow, these are my estimates, and the growth rate there are just estimates. So in 2020, I've just estimated that they'll grow 150%. The revenue will grow 150%. So that gives the multiplier there of 2.5. And then I've just reduced it the next year to 2.2. So that would be 120%. And then 2022, a growth of 80%, then 70%, 50%, 50%, 50%, and 40%. So I wanted to see how long with these high growth rates Lemonade would take to get a fair price to sales ratio. So as you can see, by 2027, in 10 years from their IPO, with these kind of high growth rates, they'd have revenue of $5.3 billion. And you can see that in the chart. 2017 and 2018 on the chart aren't even visible because they're so low in comparison to it. So using these estimates, they'd have a fair price to sales ratio of 2 by 2025. So in about 5 years, they would have a fair price to sales ratio. But these are really extreme growth rates. So this is definitely not an easy task. So it'll be extremely difficult to grow into their current valuation, but it will definitely be possible. So the current market cap is $4.5 billion. And for comparison, the biggest US insurance market cap, Chubb, has a market cap of $73 billion. And Geico has roughly about $70 billion market cap valuation, but they're owned by Berkshire Hathaway, so we don't know the exact valuation. So the reason for the extreme growth priced into this stock is because they're growing their customers really fast, the number of customers that they have. But on top of that, they're also growing the spending by each of their customers pretty fast as well. So that's why there's extreme growth priced into this stock. And some further growth factors for this company that could allow it to continue growing at these high growth rates. And they're planning to expand into new markets. So not just the US, they also offer insurance in Germany and Netherlands, I think. But I think their next logical step would be to expand into the European market and offer insurance in Europe, and maybe further down the line in likes of Australia and maybe Asia, etc., etc. Another growth factor or vehicle that they could leverage is they're only offering home insurance and renters insurance right now. So if your house goes on fire or you get burgled, your contents, whatever. But in the future, they will be offering pet insurance, car insurance, holiday insurance, etc., etc., which would obviously mean much more revenue, even life insurance. Next, I just want to briefly touch upon the risks, and I'll give you my overall opinion, and that's the end of the video. So one of the risks with this stock that I kind of stumbled upon is that once they've kind of satisfied the market of the new, like the kind of 28 to 35 year olds, of people who are just getting their first houses, like once they've kind of satisfied that current market, they're likely to take a little bit of a slowdown in their new customer acquisitions. So I think there's plenty of room to grow into this market. Like the 25 to 30 year old people who don't currently have home insurance, they all haven't started on insurance yet. But I think once that category is mostly saturated, then Lemonade is likely, in the United States, then Lemonade is likely to take a bit of a customer decline in growth rate. However, there is 5 million new homes bought every single year. So you can see the amount of young people that need insurance every single year. So 5 million people every single year buy a new home. So just to get a picture of the amount of people that will need first time insurance every year in comparison to the 700,000 customers that they have now. So yes, their growth will slow when that happens, but there's still plenty of new up and coming insurers needed every year. Another potential risk factor is that they absolutely must be able to keep their customers once they've acquired them at the young age. So if I get renter's insurance with Lemonade for my apartment, Lemonade must be able to keep me on Lemonade's insurance as I transition, because that's what their entire business model is leveraged on. Like, if they're not able to do that, it's going to be a huge impact on them. So some potential competitors, up and comers who copy Lemonade's business model, could try and undercut them on their house insurance, or even legacy companies who have more experience dealing with home insurance and insurance that costs a lot more money. They might be able to undercut Lemonade, be able to offer lower quotes than Lemonade can, and gain some of Lemonade's market share that way. So that's just a couple of risks, and yeah, obviously not everything is rosy dozy with this company. Alright, so what am I doing in regards to this stock? Right, so I really wish I had seen or heard about the stock when it IPO'd, because definitely would have bought a good few shares at that IPO price. However, I did pick up an initial position, even at $80 or whatever. I bought some shares just to open an initial position before I started really diving deep into this company. And now I know everything about this company. I think the valuation is quite high, but I think the company is amazing. But I don't think the company is absolutely like groundbreakingly amazing. So I'm not going to make it a huge position in my portfolio. For me, I'm going to make it a small to medium sized position. So I will probably add a few more shares to my position, as I'm definitely very interested in this company, and they're doing things really cleverly, and they have an enormous opportunity in front of them. However, I think this stock will be quite volatile over the next year or so, and if the stock does drop, I will be adding more and more shares if it continues to drop, because the valuation is quite high, but I think the valuation, it's probably fair for where the company is likely to go, but there are some risks along the way. So if you enjoyed the analysis, would really appreciate if you could smash the thumbs up button. Would mean the world to me. I really hope you enjoyed this deep dive analysis into Lemonade stock. Let me know what you think of Lemonade stock. Are you going to be buying it? What you think? Is there anything I missed? There's probably a lot of things I missed, but maybe someone in the audience here could let everyone else know what I missed in this company, and if there's anything that would make it more of a buy or more of a stay the hell away from this company. Make sure to subscribe if you haven't already. Blah. Really hope you enjoyed. Can't wait to see you in the next video. Thank you so much for watching, and catch you in the next one. Cheers. Whoa.